In this video, we're going to talk about how the Wolf of Wall Street scams actually worked. I'm certain you've seen The Wolf of Wall Street at least a dozen times if you frequent a business or finance-focused YouTube channel. It's a fantastic film that has gone on to influence a generation of sleazy salesmen all across the world. Hello, and welcome to Financial Fluence, where we'll teach you the most up-to-date strategies and tricks for making money online. According to Jordan Belfort, who wrote the book, this movie is only loosely based on that book, which in turn is only loosely based on fact. Numerous items were purposefully omitted from the book because if included, they may have been viewed as proceeds of crime. Similar to this, many details were omitted from the film since Martin Scorsese is an expert at charting the rise and fall of organized crime figures, rather than uncovering false stock market activity. When Jordan Belfort lost his position at the New York-based stock brokerage LF Rothschild, his career really took off. Before the year 2000, purchasing stocks did not involve just going online and entering a ticker symbol. People would actually offer instructions on which stocks to purchase and sell by calling a real-life person, a stockbroker. Well, in reality, it would frequently be the other way around, with the stockbroker calling their clients to advise them on what to purchase and sell. The same applies to learning new things. In the year 2022, all you have to do to find out the cost of GME is type the word into Google and presto! When the market was open in the 1980s, you had to either wait for tomorrow's newspaper or phone your broker. As Matthew McConaughey so astutely points out, nobody, least of all stockbrokers, knows whether a stock will go up, down, sideways, or in trucking circles, regardless of whether they are Warren Buffett or Jimmy Buffett. By processing these deals, they received huge commissions. Zero commission brokers are commonplace now, but they weren't always the norm. In the 1990s, it wasn't uncommon for deals to cost as much as 2% of the total value of the assets being transferred. Normally, a stockbroker would receive 1% of that, and the company they would work for received the remaining 1%. In truth, Jordan Belfort would go on to work at the Investor Center. Jordan actually worked for a number of businesses of this nature, but the portrayal in the film is fairly typical of these kinds of businesses. These are what are known as over-the-counter brokerages, which differ greatly from exchange brokerages, like LF Rothschild. Trades in open markets are facilitated by exchange brokerages. On behalf of the stockbrokers in their office who would be relaying deals from their clients, they would have a team of real individuals shout out trades on the floor of the New York Stock Exchange. The exchange had some level of control over all the players in this game to ensure things didn't get out of hand. But as we saw, this system was still susceptible to dishonest behavior, primarily in the form of stockbrokers pressuring their clients to make as many trades as possible to drive up their commissions. The exchange had the power to eject a single stockbroker or stockbroking firm from the trading floor if it determined that their actions were harming the reputation of the exchange. Because they wouldn't be able to conduct trades, the stock brokerage would be destroyed. Exchanges also place strict restrictions on which businesses can list on their exchanges. They investigate the management's backgrounds, audit financial documents, and make sure the company's CEO's mother doesn't answer the phone when you call their corporate headquarters. Different businesses operate over the counter. They do away with a lot of the regulation and control associated with exchanges because they do not use their services. Companies can go directly to these over-the-counter companies and say, "Hey, I need $1 million in money to undertake R&D on a new piece of radar technology that has both military and civilian applications." The stock company will respond, "Yes, but we keep 50% of the total amount we raise for you." In the best case scenario, these businesses are merely anxious for capital to implement their ideas. In the worst case scenario, they intend to swindle investors of the funds they raise. Additionally, the 50% figure was really the result of some Hollywood wizardry. The OTC brokers' profits from these deals were probably only between 10 and 20%. In either case, it should be obvious that a firm is probably not worth investing in if it needs to pay a stockbroker 20% of the proceeds only to obtain money. For this reason, Jordan Belfort and his colleagues used high-pressure sales techniques on novice investors. Jordan later established Stratton Oakmont, a division of Stratton Securities, a small dealer that was able to transact in both over-the-counter and exchange-listed companies. I'll give you some time to subscribe to the channel and give it a big thumbs up if you enjoyed the video so far before we delve any further. Also, if you enjoyed and learned something new in this video, please leave a comment down below. Let's return to the video for now. Later, after purchasing the entire company, Belfort and his co-founders Brian Blake and Danny Perush, who was represented by Donnie Azoff in the 2013 movie, began to restructure how business would be conducted. According to Belfort, he had been making money hand over fist by selling waste to garbage guys. However, he had higher aspirations. He then hired a group of brokers to aggressively pitch any stock he instructed them to. Before giving this order, he would make calls to reliable acquaintances who were not connected to him and who would acquire a sizable number of shares in a small, high-value firm, preferably one with a market valuation of less than $100 million. He would order all of the brokers on his sales floor to go out and sell the stock to whoever would buy it after his connections, or rat holes, owned a sizable enough piece of the business. As a result of the buying frenzy, the price would rise, making it easier to sell to new investors, with phrases like, "Get in now or you'll miss out." And this stock has doubled in value this week. Jordan would give orders to his rat holes to begin selling the shares once the price had reached a particular level. While this was going on, Jordan's company would make it very difficult for its regular clients to sell off the stock, and brokers would be told to purposely drop trade orders or not answer calls from investors wanting to sell. As soon as the regular investors could start selling their own stock, the price would fall. This gave the rat holes time to liquidate their stocks. Then, the rat holes would give Belfort the cash they had earned while retaining a tiny portion for themselves. When Stratton Oakmont began listing companies on stock exchanges, this technique was elevated to new heights. When a business is first listed on a public exchange, it engages in an initial public offering. This procedure involves a lot of rules and regulations, but ultimately benefits the business by making it much simpler to acquire cash from the public markets. Businesses will work with an underwriting company to help them navigate the process and take on some of the overall risk. The success of the IPO will then be the responsibility of the underwriting company. A successful IPO really means that the company sells all of its shares at the predetermined price or more. Underwriting is typically handled by investment banks, but during its heyday, Stratton Oakmont was able to woo a few businesses to use their services instead. You would have believed that Belfort's plotting would have slowed down with the return of public exchanges to the equation. He traded over-the-counter equities because he wanted to dodge the regulation and attention that come with these public marketplaces in the first place. Jordan, however, didn't let that get in the way of his plans. In fact, he created a system to make the most of both of these systems. He would give orders to his rat holes to purchase stock in a business that was about to go public. The business would then go public, and he would tell his army of brokers to sell the IPO stock to everyone they knew. Similar to earlier, this would increase the price of the stock, but this time, because it was listed on a public exchange, it would draw the interest of other investors who had no idea who Stratton Oakmont was. People would want to participate in the action after hearing the news that an IPO was up 50% at opening. The rat holes could use this buying frenzy to covertly sell their stocks, making a tidy profit in the process. By skillfully fusing the unregulated nature of over-the-counter transactions with the innate confidence investors had in publicly listed stocks, Jordan created the ultimate money-making fraud by skillfully fusing. If you haven't noticed the connection yet, this is what is known as a pump and dump, and it was how Belfort made his millions. Actually, it appeared for a while that these scams were disappearing. Investors were no longer subject to brokers who would hype up some tiny-sized firm, thanks to online stock trading platforms and simple access to market information. Unfortunately, pump and dump scams are back with a vengeance due to the development of weakly regulated crypto markets. The only difference is that instead of today's buzz stockbrokers, we have gaming influencers and Discord groups, and instead of penny stocks, we have dumb trucker meme currencies. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.